let's go to the boards and look at some charts. Today I had David Wessel on, and it was an interesting conversation because at issue here is why interest rates in the states are going so far down. And of course, the message it sends, whether you want to talk inversions, 3-month to 10-year, inverting the most it has since 2007, excuse me. But what's more fascinating is look at this chart. So here's Boone's, and we all know the all-time low yield was July of 2016. And here we are somewhat again. So the issue is, when we look at our low interest rates, let's look at the relationship between this Boone and the 10-year note. All right, so they can switch the chart. I don't know, you clap your hands here, see, it's magic. We will clear that. All right, now let's go to July of 16. Okay, so this is the same correspondence as the low yield we saw on the last chart. But the difference is, if you look at where the spread relationship is, we are now at 242, much higher. The point is that the spread is hanging constant. And if the spread is hanging constant, as rates drop with the Boones, if 80% of that contributes to the downside in 10s, what is Jay Powell going to do about that? There is literally nothing the Fed can do about it. And David Wessel said it isn't all doom and gloom, just a little bit of gloom. And I agree with that, because there is no way equity traders or any investors in the States are going to be looking at a 3-month bill yielding 235 and then think, hey, do I want to get involved in a 10-year at 225? And the relationship's going to keep compressing. And the flatter and more inverted the curve gets, the more nervous it makes the central bank. What can he do about it? I'll leave you with the answer, the final answer. What can he do about it? Call Mario and say, hey, Mario, you should have started tightening a while ago. You're gone in October, because that's about the only thing that's going to help us out as we get ever closer to 2%.